There is only one investment that saved you when times got bad, and this is it. This is the only one. No one else did this. No other investment did this other than this one. So we're going to go down here. We're going to look at this article by the Center for Retirement Research at Boston College. Wonderful article by these guys here. I don't know her name, Gary Richardson and Mark Van Orden and Valor Arthy. Ordinary Lives, Insurance Savings in America, 1861 to 1941. And we're going to come down here, and I'm going to show you a page. What page is this? Page 7. Hang tight right there. During the 1930s, savings via life insurance accelerated while savings via other sources declined. Most banking loan institutions became frozen, with members unable to convert shares to cash and market values for the shares falling by 50%. Many banks failed, and depositors drew down balances in the banks that remained open. Stock prices declined by more than 95%. Thousands of firms failed, and the value of their shares evaporated. Life insurance, however, remained liquid, solvent, and safe, and continued to pay interest, typically of 3.5%, so individuals increased savings in life insurance by large amounts. I'm going to include, they didn't really have fixed annuities back then like we do now, so I'm going to include fixed annuities in this. Insurance products, cash value insurance, be it life insurance, whole life insurance, permanent life insurance, or annuities. It's the only thing that saved your bacon, not just during the Great Depression, but also during the 2008 global financial crisis. Oh, but government bonds did fine. Government bonds did not do fine in 2022. They just did not. All right, so 2022, government bonds got killed. Life insurance did not. Whole life insurance did not. Annuities did not. It was just a fact. Banks did fine in 2000. They did not do fine in the Great Depression. There's only been one investment that never had these kind of down years, and that's it. It's life insurance, and I'm going to, again, annuities are an insurance product for sure. Check this out. This is crazy, man. So we scroll all the way down. Go, go, go. He could go all the way. Josh Payton. I'm going to show you right here. Check this out. It's crazy. All right, so right here. Savings rates relative to annual income. You can see all savings right here in the checker thing. And the lower the annual income, they were actually taking debt on. They were having negative savings rates, except for their insurance. They were still, while they're taking debt on right here, and this is 1935, I should say, 1935, they were taking debt on, they were still have positive savings rates into life insurance. Isn't that interesting? Yes, it is. Now, once you got up here to the more wealthier people, they had positive savings rate for all savings to include life insurance. But again, look at that. Negative cash flows until you got to right about $2,000 a year. $10,000 a year is about $250,000 in today's dollars, all right? And that's only about 1% of the households that make $250,000 a year. So you can see right here, this is a very rarefied era group of people. So this would probably be your average median right here today, $60,000, $70,000 right there. So only right about there did they have positive all savings for everything, because they're still taking debt right here, except they still made sure to save in their life insurance. Isn't that interesting? Check this out. From 1920 to 1936, corporate equities is in this large thing here. You can see it goes down, it goes up, it goes up, it goes down, it goes up, it goes down. Then it falls off a cliff in 1929. So your savings via corporate equities fell off a cliff when the freaking bear market came. Even here, after it jumped up, it's still in the negative. This is zero. It never got back to zero from 1929 to 1935. It was still negative. People were still selling shares relative to their investing. They were still taking, basically selling stuff. Selling stuff. They were selling more than investing. But what were they doing? Life insurance? Life insurance is the dark black right here. Still going up. Still positive savings. And here you can see right here, we got deposit and banks are falling. We got savings into buildings and loans falling. Building and loans, not bank and loans, building and loans falling right there. So you can see everything, well, the only positive thing we had was in life insurance across income levels and across time as well. Isn't that interesting? So let's keep going up here. Hang tight. Before Social Security, most retirees earned little from savings in banks, bonds, or stocks, and few had pensions. Interesting. What did ordinary people do when they retired? Right here. That savings vehicle is ordinary life insurance. It was the most common contract. It was a savings vehicle that paid a specified sum to the insured if they survived to a designated age. accumulated cash value throughout its term that the insured could access whenever they desired, and pay the specified sum to a beneficiary if the insured died before the contract matured. Let's go all the way down again. I'll show you exactly how it works. Again, this is not annuities, but annuities work similar, kind of the same concept here. I'm going to show you very interesting. It's just to get it visualized, you'll see. So right here, initial policy, you got a $5,000 face value. All right, so if you die, your wife is going to get $5,000 or your husband. In the interim, you're paying an amount of money, you're accumulating cash value is accumulating until at some point you're just going to have this $5,000 face value and the $5,000 cash value as well that you could use for retirement. That's how it works right there. So that's a very interesting policy. I mean, basically almost like a zero coupon bond. You're saying, all right, I'll have $5,000 today to insure my life, and that way I'll assure my retirement. I'll have $5,000 in the future. I'll just keep paying it up. That's how these work right here. Annuities don't work like that. Annuities work, you're just saying, I'm going to put $100,000 in an annuity today, and I'll have access to it later on when I want, either deferred annuity or an income annuity. I'll have an income stream I cannot live right now. That's just how these things work. It'll never go away, ever. But the insurance company could go bankrupt. Show me evidence of this happening. Show me evidence. I mean, just the evidence is very, very rare. From 1900 to 19... Oh, I can show you this too, actually. Hold on a second. Growly. We got Growly McGee over here. He wants to growl. Growly McGee. He sees a bird outside. How dare he, Growly McGee? Let's see if I can find this. 1900 to 1940, aggregate savings via legal life insurance, which issued all ordinary life policies, rose from 50% to 200% of annual national income. Savings poured into life insurance in the 1920s, when savings via insurance roughly equaled savings via all other financial intermediaries, including of stocks and bonds, building and loans, deposit and commercial banks. Crazy. Let's keep going here. We're going to show you just right down here. Right here, MetLife's ordinary life insurance policy, which was the most popular life insurance policy, it may have been one of the most popular investment contracts of all times, since during each year of the 1930s, about 1% of the national income of the U.S. was invested via this policy issued by MetLife. 1% of national income was invested in MetLife ordinary life insurance policies. And you can see right here, building and loans, bank deposits, life insurance. Savings during the roaring 20s and the Great Contraction. Savings from 1920 to 1935 in life insurance was right there, 25,000, whatever it is. I'm not sure how much that is. But anyway, and millions of, I'm not sure. But anyway, look at this. And corporate equity was negative savings. Savings in building and loans, 1/6 of the savings in life insurance. Savings in bank deposits, 1/6 of the life insurance. Returns on ordinary life insurance companies. So if you die in year one, it's a 4,572% rate of return. Not too shabby. If you die in year 60, you got an annualized 2.1% rate of return. And during those years, with little to no inflation, sometimes deflation, that's not a bad rate of return. If you died in year 30, it's a 4.9% rate of return on your face value. I mean, that's not bad, man. That's not bad total. You get 1.5 on dividends, you get 3.4 on investments. Not too shabby. And let's keep going. Insurance in force relative to national income. At the midst of the Great Depression, there's 200% more insurance in force than there was national income, and yet you didn't hear anything about insurance companies going bankrupt. Per capita in insurance by force. Income nominal per capita, right here. Look at this. The amount of insurance in force was almost twice that of the national per capita income. And again, you didn't hear anything about insurance companies going kaput. It's crazy, man. Look at that. $800 per capita was in force, and only the income was $500 per capita national income. The savings rate, look at this, man. Life premiums income as a percent of national income. Life premiums is in the blue. At the top of the Great Depression, there's 7% of the savings rate was going to life insurance. It's crazy. People are saving an insane amount of money into life insurance. We are on top of this. But to say it's a scam when it saves countless people during the Great Depression, it saved, I'll never forget my man David Tedesco, RIP. And he's the first guy that ever introduced me to life insurance, because I was always one, buy term and invest the rest, only idiots buy life insurance. And during the great financial crisis, he's like, let me, how's your portfolio doing, he'd say. just say generally to speaking, not to me specifically, and everyone's getting crushed. We check the cash value of my whole life policies. I'll never forget that, dude. I'll say, man, so he just wrote it out just fine, just fine. Now he didn't make as much money as S&P 500 over the last 15 years. I'll tell you that. But during those times of crisis, from the aughts, he did fine. If he was alive during the Great Depression, he did fine. It's just a fact, dude. It's just a fact. Very, very few people had equities back then in the 1900s. The only thing they really had was banks, which were scary, or life insurance, which turns out to be not nearly as scary. So to discount life insurance and annuities as scams or what after the life insurance company goes bankrupt or something like that, it didn't go bankrupt during the Great Depression, and they're heavily regulated more so now. You think they're going to go bankrupt now? I mean, I don't know. I just said this is the only investment that is proven to secure your retirement. Nothing else has come close. Government bonds did not do it. Remember, government bonds got smoked in 2022. They just did, and there weren't really enough government bonds in the Great Depression to even think about. I don't know what the rate of return on government bonds was back then. We just don't know because there weren't very many issued because the debt was so limited relative to what we have today. But at the end of the day, government bonds can take it on the chin as well because government bonds have a fluctuating price. And if you need to liquidate a government bond when the interest rates have gone up, you're SOL. Now, on the other hand, if you need to liquidate a government bond when the interest rates go down, you're good. But still, life insurance doesn't work like that. It just is. All right. Love your thoughts. God bless. Smash that like button. We'll see you.